Good afternoon. We're giving everybody a chance to kind of get through the technology and get situated before we start. We are recording today's session, and we will start in about 30 seconds. Okay, let's go ahead and get started. We have so much information to cover. We don't want to waste any of our time today. My name is Melissa Stewart. I'm the Executive Director with the Texas Restaurant Association for the Southeast Texas, Greater Houston area. It is absolutely my honor to be here today, and I could not be more pleased with the topic. We know that this last year has been challenging. Unprecedented is the term I'm trying to stop using because every time I say that, something else worse happens. But one of the biggest things that's happened is we've got so much going on financially that's really complicated, and we're into that season where we're going to have to start reconciling for the last year. And I'm just thrilled to death to have on our board here in Houston, Ms. Krista Jagannath, excuse me. And she is an amazing member, and her firm, Briggs and Vescala. I knew I was going to say it wrong. Briggs and Veselka, excuse me. The harder I tried to get it right, I knew I was going to have it wrong. Have just been really great partners for us and sharing a lot of information out to our members. And so without any further ado, I'm going to turn it over to them so we can get the maximum out of it for this session. Krista?
Thanks so much, Melissa. I appreciate that. And thanks so much for the Greater Houston chapter for having us as well. As Melissa said, I'm Krista. I'm an audit principal with Briggs and Veselka and also the restaurant and hospitality practice leader. We're a CPA firm headquartered in Houston, but we also have offices in Austin, San Antonio, El Campo, and the Woodlands. So we work with several restaurants. We also work with food and beverage distributors, breweries and distilleries in the state of Texas. And so with this background, and while there's so many changes going on, the presentation that we've specifically developed today is to cover the most common questions we've been receiving within the industry. And so I do want to put out the disclaimer that the information we're covering may be subject to change. As you're aware, changes have been occurring rapidly, and it's definitely been keeping us on our toes over here. So if you do have any questions, please feel free to submit them in the Q&A box, and we will carve out some time towards the end of the program to answer as many questions as we can. Any unanswered questions, we'll be sure to follow up directly afterwards. So I don't want to take up too much time. We do have quite a bit to cram into this hour. So we'll go ahead and dive straight into the program. So the first topic that we want to discuss is gift cards and customer incentive programs. So these programs, have been around long before the pandemic. But as many operators were looking for ways to boost cash flows and retain customers, there was an increasing trend of marketing and being strategic with these programs. So let's go ahead and start with gift cards first. Gift cards are great to assist with cash flows. A customer purchased a gift card today, you receive the cash today, and you owe a service in the future. So at the point in time of the transaction, you are recording the cash on your books, and then you have a deferred income liability because you still owe a service. So you can't recognize that revenue until you've actually completed that service. But I'll tell you what happens. There are many customers who forget to use their gift cards, or they lose their gift cards. And what happens is that you have this growing liability account of unredeemed gift cards that have just been sitting there for years. So a solution to this was released a few years ago to help recognize revenue for those unredeemed gift cards by recognizing what they call as breakage. So breakage is taking in consideration the probability of the gift cards not being redeemed. And so the company would have to utilize historical data and trends to develop a policy of recognizing revenue for those gift cards that haven't been redeemed. So maybe that's each year that has passed by that the gift card hasn't been redeemed, we're going to recognize 20% of the revenue. Or maybe it's gift cards over 3 years old, it's remote that they'll be redeemed, and we're going to go ahead and recognize. So there has to be some type of methodology behind your policy, and it needs to be consistently applied each year going forward. Now, if your gift cards have an expiration date on them, then we're entering a completely different ball game here. Once the gift card has expired and it was not used by that customer, you unfortunately cannot recognize that revenue. Instead, you have to remit the amount to the state as unclaimed property. So I know many of my clients hate hearing that. And so I think over time, a lot of businesses have moved away from the expirations on their gift cards, but if you still do have them, keep that in mind that you really are going to want them to redeem it. Otherwise, whatever is not redeemed at the expiration date does have to go to the state. So that's a quick summary about gift cards. I wanted to make sure we touched on this because with the pandemic, e-gift cards were very popular in a remote setting, just to show appreciation for employees, or maybe we're celebrating family members. And kind of forward looking, those certificates can build up on your balance sheet over time if we're not accounting for it properly. All right, so the next consideration is loyalty programs, which also became more popular during the pandemic. I can also say for myself, I know I have way more apps on my phone than I did before. And so a new revenue recognition standard went into effect over the past year or two, which clarified the proper recognition of loyalty or reward programs. Basically, what's happening here is that when a customer makes a purchase and they earn a reward certificate or they earn points, a value or price gets allocated to that reward. And a portion of the sale today is deferred until that certificate or those points are redeemed or it's been expired. So I'm more of a visual person, so I wanted to provide an example of this on the slide. So let's say, for example, for every $100 I spend, I earn a $20 certificate. So although I'm paying $100, you aren't recognizing $100 today. Instead, you have to take in consideration the value of the service being provided, which is the $100, plus the rewards provided for a future service. So that total consideration is $120. Then you're going to say, okay, I have $100 cash, but $120 of consideration in exchange. So I'm going to take 100 divided by 120, and that gets me to 83%. So I can only recognize 83% of the $100 in sale today, and the remainder of the $17 will be recognized when the customer redeems their certificate. So most loyalty points or certificates, they do have an expiration date. Normally it's within a month or within a year, and so it's more short term. So if they are unredeemed, it's more manageable to recognize the revenue. It doesn't have as much of a buildup effect like gift cards do. So, as you can see, when we're developing these incentive programs, it isn't so simple when it comes to accounting for it. And I know at the end of the day, just to avoid the chaos of deferring and allocations, you really just want your customers to redeem their rewards and utilize their gift cards sooner than later. So I know I went through that really quickly. The next topic that we're going to cover is tax updates and considerations for your 2020 and 2021 tax returns, which we've seen quite a bit of extensions roll out, which should give you all enough time to assess if you're able to capitalize on some of these items. And so I have Kaylee Prescott here. She'll be leading the portion of this session. Kaylee is a tax senior manager at Briggs & Maselka, and is also part of our restaurant and hospitality team. She works with several operators in Houston, and we're really glad to have her support in the tax arena. So Kaylee, I'm gonna go ahead and pass this along to you.
Thank you, Krista. Glad to be here today. Glad to have this opportunity to chat with y'all and share some tips and things that hopefully will help you as you go through this 2020 tax season. I did want to mention, feel free to send questions in the Q&A box down below. We are monitoring it, and if we don't answer it live, if we don't answer it within the webinar, we can try to reach out to you after the fact, but feel free to send your questions our way. So I wanted to start out by addressing the tax extension that was actually granted to the entire state of Texas, given the winter storm we had in February. So for all of Texas, the IRS actually postponed certain tax filing and tax payment deadlines out to June 15th. So we all have a few extra months to get our stuff together and get things filed, which I think will be a welcome relief for many of us. So for example, if you file a 1065 or an 1120S business return, normally due March 15th, that's automatically been extended out to June 15th. Your personal individual returns, trust returns, and C corporation returns that are normally due April 15th were also automatically extended. As well as the first quarter payroll and excise tax reports that will normally be due April 30th. Those are also extended out to June 15th. It's automatic. There's nothing you need to currently file or do. And then just make note though, regarding the payroll taxes, tax deposits must continue to be made timely. There was a short period in there, February 11th through the 26th, where if you didn't make that deposit timely, penalties will be abated as long as they were made by February 26th. So this extension for Texas does actually include an extension to pay your taxes. So you can probably hold on to your money an extra 2 months this year. If you would have owed income tax with your return by April 15th, whether you were ready to file or if you would have been filing an extension, now those payments are extended out to June 15th. And also if you pay quarterly estimated taxes, that first quarter of 2021 is also extended. You have until June 15th to make your 2020 IRA contributions. If your business is a fiscal year end filer, just know that if your return had an original or an extended due date between February 11th and June 15th, those are extended as well as any of your estimated tax payments that fall within that time frame. And you may have actually heard this was just announced yesterday, but the IRS was under a lot of pressure to extend the April 15th deadline this year. So they did grant the rest of the country until May 17th. And just because of the pandemic and the numerous tax law changes that we've had within the last year, it's just a lot for everyone to get their arms around. And even the IRS themselves are very backlogged at the moment. So given this extension, we do expect that many states will follow suit and issue their own extensions eventually. And so one other form of tax relief that's been offered to Texas given the storm is the ability to deduct casualty losses on your tax return. So as an individual or as a business, if you suffered any damage to your property as a result of the storm, whether it was a bust pipe or water damage or expensive landscaping may have died off, you can claim a casualty loss for those damages. Now, although the winter storm occurred in 2021, you can claim the loss on next year's 2021 return, but there's actually an election to claim that loss on your 2020 return, which you're probably working on right now. And if you do that, you could recognize a quicker benefit in doing so. And then the state of Texas came out with a form of extension relief as well. They have automatically extended the May 15th deadline for the Texas franchise report. They extended that from May 15th out to June 15th to kind of sync up with federal. And like I that said, just given this past, 365 days, I think a lot of us are coming up on our 1-year anniversary of, working from home or just dealing with this pandemic. There have been about 4 or 5 major pieces of legislation passed. So my goal today was to sort of hit on the high points, the things that I felt would be relevant to a restaurant or restaurant owner. The first one being QIP, Qualified Improvement Property. So qualified improvement property, the benefit here is that you can claim a 100% bonus depreciation write-off for certain costs that you incur. So QIP would include improvements to the interior portion of your restaurant or other non-residential building. It does not include enlargement of a building, escalators or elevators, or any work done to the internal structural framework. QIP would include costs incurred between 2018 and 2022. Examples may include ceilings, flooring that's more permanent in nature, wall coverings, interior doors, electrical, fire protection, lighting, millwork, mechanical, plumbing, and others. The key to QIP is that it has to be placed in service by the taxpayer after the building is placed in service. So if you were to purchase the building and the former owner had made improvements, that does not qualify as QIP. One thing that's maybe relevant to a lot of restaurants is if you're a tenant in a property. As a tenant, if you make qualified improvements and you're the owner of those improvements, then you're allowed to claim the bonus depreciation rather than the landlord. And the other reason I wanted to touch on QIP is because the CARES Act that came out in March 2020 actually made a retroactive correction to QIP in the tax law. So previously, when the law was first written, the Tax Cuts and Jobs Act that established QIP, there was actually a drafting error. It wasn't well written. So what happened is these costs, you had to depreciate over a longer time period, 39 years. There was no immediate benefit, not eligible for that bonus write-off. When the CARES Act came out in March 2020, you can actually go back to your 2018 and 2019 return. And if you had incurred these type of costs, but you did not write them off in full, you have a couple options. You can go back and amend 2018 and 2019 to pick up that extra depreciation, potentially end up with a refund, or you can file what's known as Form 3115. You file that with your current 2020 return that you're probably working on now, and that helps bring down your taxable income. So that's just one planning opportunity to keep in mind if you know you've made improvements in the past few years. The next point is on net operating losses. So the CARES Act amended the current rule on NOLs. As of a year ago, the rule at that time was that if you incur an overall loss, you can only carry that forward to offset future taxable income. You could not carry it back. Some of you may be familiar with the ability to carry back your losses to a prior year when you had income and recoup some of the taxes paid and get a tax refund. Well, the CARES Act now opened that back up. So for 2018, 19, and 2020, you can actually carry it back 5 years. So for example, a 2019 NOL can be carried back to 2014, or the first year of taxable income that falls between 14 and 18 for a tax refund. I have clients now where, 2020, definitely not the best year, expecting to have overall losses. So they are eager to get 2020 filed, and then we can proceed with carrying back that loss to a more profitable year in the past and get them some money back. It's done a couple ways. The quickest way is to file an 1139 or 1045. Those forms, the IRS has 90 days generally to process, as opposed to going back and amending those prior years. These other forms here are a quicker method of getting your money. So the next area is in regards to PPP. This was a bit of a controversial topic for a few months there. When the PPP program was first released, the intention of Congress was that the forgiveness of these PPP loans would be tax exempt. And I think everyone was on the same page that the PPP loan forgiveness would be tax exempt income. You would not owe tax on that. However, the controversy kind of came into play in regards to the related deductions. So if your PPP money covered payroll, rent, things of that nature, the intention, Congress's intention was that those expenses would remain deductible on your tax return. But the IRS took the position that they should be non-deductible. They were quoting certain code sections and precedent that expenses related to tax exempt income should be treated as non-deductible. Very unpopular opinion. However, in the Consolidated Appropriations Act that was passed just recently in December, it corrected this issue, and your PPP covered expenses are now deductible, which I can tell you is saving taxpayers and clients a lot of money. And I also wanted to touch on the Texas Comptroller's position on this. As of today, and as Krista mentioned, all of this information is as of today, so this is subject to change. As of today, we look at Texas statute, which does not provide for the PPP loan forgiveness to be exempt from the Texas franchise tax. It would require a legislative change. However, there is a bill currently that's been introduced and filed for exemption from revenue. And my hope, and this is just my personal opinion, but Texas being a business-friendly state, my hope is that they do come out and make it tax-free for Texas purposes. They do, however, make a statement saying that your PPP covered expenses can still be deducted on a franchise tax report as part of your cost of goods sold deduction or compensation deduction, regardless of whether your PPP loan forgiveness ends up being taxable or not. And just keep in mind, if you operate in other states, the conformity will vary, the conformity with the federal treatment. There is a good chart online, I believe it's taxfoundation.org, that is a map of the United States, and you can see exactly which states plan to tax PPP loan forgiveness. If you had an existing SBA loan prior to PPP, just their typical 7A, 504, or microloan program, the CARES Act also provided some debt relief there. You could have had up to 6 months of payments paid on your behalf by the SBA. And there was a second round of this within the CAA. So if you did have any of these payments made on your behalf, those payments are tax exempt income that will not be taxable to you. And on the other hand, the covered interest and fees that were paid for you are also still deductible to you. So it's very similar to PPP treatment, but just something to keep in mind if you were a beneficiary of that provision. And so here I wanted to touch on some of the changes to charitable donations. I think these were put in place to incentivize people to be charitable last year. Definitely a lot of people in need, a lot of opportunity to help others. If you're an individual that does not itemize on your personal income tax return, but you made up to $300 in contributions, you can claim that extra $300 deduction on top of the standard deduction that you'll be claiming. And that increases to $600 for a married filing joint couple in 2021. The CARES Act also established that an individual can deduct up to 100% of their AGI They can deduct a charitable contribution amount up to 100% of the AGI. Previously, that was limited to 60%, and that's been extended to 2021. Qualifying donation for this purpose, it must be made in cash, so no non-cash donations, to an eligible organization, which is really a broad term. It's pretty much your 501c3 public charities and maybe some other types of nonprofits. And one other stipulation is that it cannot be made to a donor advised fund. If your company is a C corporation, in the past, your charitable deductions were limited to 10% of the corporation's taxable income. That's been increased to 25%. Donations of food inventory, this deduction has been increased. So previously, you could take a charitable deduction for food inventory up to 15% of taxable income. That's been increased to 25%. And also, just wanted to point out as a reminder, the deduction that you can claim it up to the amount of the basis you have in that food inventory, plus 1/2 of the gain that you would have realized if you would have sold the food instead. Some other miscellaneous changes, just wanted to touch on these quickly. The FFCRA, there are employer payroll tax credits if you pay an employee sick leave, whether they are sick themselves related to coronavirus, or if they have to take off work to take care of a family member. There are payroll tax credits available that are pretty much dollar for dollar the wage that you're paying them while they're out, up to, of course, a certain limitation. But I've seen clients really take advantage of this. So it's something to keep in mind, and it's available through March 31st of this year. Taxpayers or employers had the option to defer payment of certain payroll taxes, which was their share of Social Security tax. That expired December 31st. So if you took advantage of that, just keep in mind that those taxes that you decided to defer, 1/2 is due at the very end of 2021, and the second half is due at the very end of 2022. There is currently a 30% limitation on the deduction for business interest expense. That was increased to 50% as part of the CARES Act, and there are different rules in place that do apply to partnerships. Multiple classes of excise taxes have been adjusted or reduced on, for example, beer, wine, and distilled spirit. And then multiple tax credits have been extended, such as the new market tax credit, the work opportunity credit, the general business credit for paid family and medical leave, as well as the health coverage tax credit. And so my next slide is on the American Rescue Plan Act, which was actually just signed by the president about a week and a half ago. I'm not going to read through each of these. Some of these are more so individual provisions. They're good to know, which is why I included them in here. The one I probably wanted to touch on would be the unemployment benefits. They were extended through September 6th of this year. And for anyone that received unemployment benefits, the first $10,200 will be exempt from taxation. And as part of the American Rescue Plan Act, you're probably already familiar and have heard about the Restaurant Revitalization Fund. $28.6 billion was set aside within the SBA. $5 billion of that is reserved for businesses with gross receipts of $500,000 or less during 2019. This is going to be a tax-free federal grant based on your pandemic-related revenue loss. So you start by calculating your 2020 gross receipts, you subtract your 2019 gross receipts. So you start with that dip in revenues. And then you do have to further reduce it by the amount of any PPP money you received. And the grant is capped at $10 million for a business and its affiliates, and limited to $5 million per physical location. This slide and the next slide, I will say these points I was able to borrow from the National Restaurant Association. They have a really great 1 or 2 page summary of how the fund works and the highlights. So this is so new, but I still wanted to include this here to help make anyone aware. So in the first 21 days, the SBA plans to prioritize certain groups of business owners, including women, veterans, or socially and economically disadvantaged small businesses. The covered period includes February 15th of 2020 through December 31st of 2021. Eligible expenses include payroll, mortgage principal or interest, rent, utilities, normal food and beverage, inventory costs, certain supplier costs, as well as supplies such as PPE or other protection type equipment. It's very similar, from what I understand, to PPP2. I think the difference is that this grant does cover your food and beverage inventory, and I believe it includes amounts owed to your suppliers, whereas maybe PPP2 does not cover those type of costs. And then they sort of avoided the issue we had with PPP, and they went ahead and made it clear that the grant will be tax exempt and your expenses will be deductible. And eligible entities are those that own or operate 20 or fewer establishments as of March 13th of 2020. There are affiliate rules that do come into play. Here is a list of the type of entities that are eligible, the type of restaurant operations, and also publicly traded companies are not eligible. And I do want to refer back, because I borrowed these notes from the NRA's policy brief. I thought was really well written. And so that's all I had. I'll pass this back to Krista. If you have any questions, feel free to put it in the Q&A and we're happy to help.
Thanks so much, Kaylee. Also want to put an FYI out there. I know this is a lot of information that we're going to be throwing out to you, and just want to let you know that we will provide a copy of our slides to the association to provide to the members and the attendees, just so you can have that as a reference tool as you speak to your accountants. All right, so we've just covered the tax updates. Now we're going to move into another common question, which is, how do we account for the PPP loan and the forgiveness on the financial statements? So there's really 2 main options. It's either as debt or as a grant. And so to determine which option to follow, you would need to analyze all of the facts and circumstances regarding your PPP loan, and then determine, is it probable that the company will meet both the eligibility criteria for a PPP loan and the loan forgiveness criteria for all or substantially all of your PPP loan. So if you cannot support that you'll probably meet both of those criteria, then the PPP loan should be accounted for as debt. However, if you do feel that it is more than likely, it is probable that you'll meet both criteria, then you may be able to account for it as a grant and initially recognized as a deferred income liability. So essentially, both will be recorded as some sort of liability on your financial statements, but the derecognition process will be different. So when the PPP loan is accounted for as a debt, you would follow the normal protocol of accruing interest. You would derecognize the debt if you've made payments or you have been legally released or forgiven by the lender. Once you receive the notice of forgiveness, you would then remove the liability from the balance sheet and record it in other income. You would not record it as your normal revenues from operations. So that's very key there. Now, looking into grants, the PPP amount would be recorded as a deferred income liability, and the company would derecognize the liability over a period of time as you are incurring the expenses for which the PPP is being used for. So it's more of a systematic derecognition rather than all at one time when you receive the notice. So as you're incurring the payroll expenses, you're relieving the PPP liability for the same amount each month, causing a net effect of zero in most cases. So the income statement presentation can be one of two ways. You can either offset it with the related expenses or present it as other income on the income statement. And so those two options are really only available if you're going the grant route. So that's a very really high level understanding of the two methods to consider. We've been rushing through the first couple of slides just because we know we're really the opening band for the next topic, which is the PPP update and employee retention credit. So Jonna Kelly will be leading this session, and it's part of our outsourced accounting and advisory department. She's also our tax and PPP expert, and we are so fortunate to have her on our team. As you can imagine, she has had many late nights and is probably having dreams about PPP changes at this point. But appreciate Jonna being a part of this session. I'll go ahead and pass it over to you, Jonna.
Thanks, Krista. It is a pleasure to be here. It's actually an honor to work with our clients on PPP loans and in retention credits. There's a lot of stimulus out there for our business owners, and we really are proud to be able to offer assistance in this area. I want to start on the first slide with just some basic headlines in case you missed a few things. Of course, there's a second draw. The current deadline for that second draw is March 31st, but you may have heard that a couple of days ago, the House recognized and passed an extension to May 31st, almost unanimously. So there's great hope that the PPP2 second draw will be extended a little further to allow time for others to apply. There was some expanded costs that are now available. They updated some of the forgiveness applications so that people under $150,000 loan sizes would have a more streamlined process. There was some changes to the covered period. No longer do you have to choose between a strict 8 or 24-week covered period, but you can use any time frame in the middle, which does help a little bit. Now we can also take a PPP loan and an employee retention credit. So we're going to spend some time today talking about the interaction of those two. And then, as you probably heard, the EIDL advance, which many people received, that's different from an EIDL loan. An EIDL advance is normally in the $10,000 range. That's no longer an offset to PPP forgiveness. So some of the new features, the qualified cost is a nice addition, especially if you are going to take advantage of the employee retention credit. As I said, we're going to talk about how to analyze both of those, but if you're taking the employee retention credit, you really want to minimize your payroll costs for PPP forgiveness, thereby allowing you more costs to allocate towards that credit. So if that is the plan, then you're going to want to increase the amount of qualified costs that you declare. So some of the new qualified costs that are kind of been briefly discussed this morning are operation expenditures, such as like software or cloud computing software, property damage due to vandalism or other public disturbances, supplier costs. Kaylee mentioned some of this briefly earlier, for the supply of goods that are essential to operations. And then some PPE or worker protection equipment is also now considered a qualified cost for forgiveness. So what's changed with the second draw? Well, it's very clear that the second draw was intended to really hit the hardest of hit businesses. So no longer is it open to basically everyone that feels that they needed the money, but it's now restricted to those that can exhibit a 25% gross revenue reduction for any quarter of 2020 as compared to the same quarter of 2019. The amount is also restricted. So no longer can you get a loan over $2 million. All loans in the second draw are 2 million or less. And there's also some limitations for the number of employees. Of course, I know in our audience today that you've probably already heard that there's special considerations given to those that have NAICS codes of 7.2 or begin with 7.2. And so that in that way, it's similar to the way the first draw limitation of 500 employees was on a per location basis. So PPP2, many borrowers ask me, well, I haven't actually applied for forgiveness for PPP1. Well, rest assured, you don't have to have applied yet. All you have to say is that you either have or will use the amount of PPP loans that you received in the first round, which pretty much to a fault everyone plans to use. You can't be permanently closed. Now that doesn't mean you can't be temporarily closed, but any kind of permanent closure where there's no intention to restart the business, you would not be allowed to get a PPP2 loan. Then as we discussed, there is the revenue test where you're comparing 2020 to 2019. If you're asking for a loan size of 150,000 or less, you don't actually have to prove that revenue reduction when you apply, but you will have to prove that revenue reduction when you ask for forgiveness. So be very cautious there that you can substantiate that revenue cost. The revenue should be in whatever form, received, accrued. Often I'm asked, well, what basis of accounting? Are we talking cash basis or accrual basis? There isn't anything specifically in the guidance that tells us which one is correct. So the understanding is you can use either. Common convention is to use the same method of accounting that's used on a tax return, because that allows you to substantiate those numbers and show that they tie to your final tax return numbers. So for the hospitality business, suppose you're going in and you're trying to create an application for a PPP2 loan, you have a little bit of an extra bump in that you can use 3.5 times the monthly payroll, whereas every other borrower is only using 2.5 times. So that's a big difference. And in addition, as we said, the 300-person employee cap is per location. And restaurants and lodging are also not subject to the SBA affiliation rules. And that's really important because a borrower that may be in a different industry has to look at their revenue across all their affiliated entities, whereas in the restaurant and hospitality business, they do not. So these are the current forgiveness applications. They're set up so that you can use the simplest of all. So for a loan of 150,000 or less, we always advise using the 3508S, S for simple. It's fairly straightforward. It provides just that you certify some statements by giving initials on the form, and there is some support, but generally it is the simplest of the 3 forms. We always encourage our borrowers, no matter how simple the application you are using, create a good paper trail of the PPP forgiveness process and the application process. At any time in the next 6 years, the SBA could ask you to substantiate something that was on the application or the forgiveness application, and you'd want to have a good paper trail. Second simplest application for forgiveness is the 3508EZ. And that is probably the most relevant of all the applications for those on the call, because there are 3 ways that you can actually use that easy. Well, one of that we have frequently is a borrower that says, I did not reduce anybody's salary or hourly wages, and I kept everybody on the payroll, no changes. In that case, you can use a 3508EZ, but you can also use that form if you can state that you were partially or temporarily closed during that time frame, which is of course true of quite a few restaurants during the pandemic. That will allow you to use a simpler form. And then the 3508 is probably the longest form, and it certainly has more support. But one thing that we often tell borrowers when you're going through the forgiveness process is that no matter which form you're using, the background calculations are really no different. You still need to be able to calculate how much you used for payroll. You still need to keep all of those records. You still need to calculate your full-time equivalents based on a 40-hour week. So there's quite a bit of calculations in the background that you'll still want to do. But filing the simplest form does somehow seem to make the process with the lender and the SBA a little more simple. So if you're in the over 2 million loan space, then you've probably noticed that you're being asked to provide what is called the Loan Necessity Questionnaire. There's 2 of them. The 3509 is for for-profits and the 3510 is for a nonprofit. When those came out months ago, that did give people some concern. When you applied for PPP-1 back in the middle of the pandemic, I'm sure we can all remember how difficult it was and how much there was that we did not know at that time. And quite a few borrowers asked for funding and felt like it was a necessity. Now there's a questionnaire. No one anticipated this. I try to tell borrowers, this is just the SBA trying to get an idea of how much you really needed the money through some sort of formalized process. And it's only for the over 2 million borrowers, which they've already stated they're going to review. And it gives them a first line to take a look at, well, do we need to ask further questions in these cases? I find it interesting that on the form, there's a little bit of dialogue I want to point out here. It says a request to complete the loan necessity questionnaire does not mean that the SBA is challenging a borrower's certification. So it's important to remember that it's really not something to be afraid of. It's an important form to fill out and to be complete and as accurate as you can be, but it doesn't necessarily mean that trouble is ahead. So in addition to PPP funding, which was done through the SBA, there's a great deal of payroll tax type funding, which that's through the IRS. And that's an important distinction to make. And we like to think of this as government funding, and it is coming through a government body. But there's a very different spirit among those at the SBA than there is in the IRS. So what we're going to talk about now, and Kaylee briefly mentioned some of the other funding options, which I've listed here, but what we're going to focus on now is the employee retention credit. So previously, the employee retention credit wasn't on anyone's radar because PPP was the talk of the day. If you had a PPP loan, you couldn't take the employee retention credit, and therefore no one was really thinking about it unless you were somebody that didn't apply for the loan. Well, on December 27th, that changed, and all of a sudden, people became eligible, even historically, for the employee retention credit. Unfortunately, the employee retention credit, as I said, is through the IRS, so it works very differently, and it's easy to get these two confused. To further complicate things, the rules for how the employee retention credit work are different for 2020 than they are for 2021, and they continue to be updated as recently as last weekend. So let's talk about the 2020 credit, first of all. The 2020 credit is refundable, so therefore, when you go through the process of claiming it, you should receive a refund for that amount. It's for businesses who are either fully or partially suspended due to a government order. I suspect that's many on this call, so we'll talk about that in really great detail in a minute, or who experienced greater than 50% reduction in revenue for a quarter in 2020 compared to the same quarter in 2019. You may also meet the requirement using that eligibility. And it continues, and this is interesting, the employee retention credit continues for 1 quarter after you get back to 80%. So you'll see in some examples, but I'll briefly point out here that if you are eligible in quarter 2, because you're at 50, let's say you're down 60%, and in quarter 3, you're back up, maybe you're only down 10%. You get to continue taking the credit for quarter 2 and quarter 3. It doesn't stop until the quarter after you get back to at least 80% revenue, which is very helpful. It's for any size organization. However, it does have a large employer, small employer component that we're going to talk about in a minute. And the credit is $5,000 per employee, but it's maxed at $5,000. So you're going to allocate $10,000 of wages per employee annually and then take 50%. And we'll get into the details in the next slides. So what's a qualified wage? Well, a qualified wage is the normal gross wages that are subject to Social Security and Medicare tax, have allocable group healthcare cost. It's all wages paid between March 13th. Remember, we're only talking about 2020 right now. So between March 13th, which is kind of the official beginning that we considered the pandemic, so you'll see that date a lot, and December 31st of 2020. As I said, it's $10,000 per employee, and then you take 50% of that. So let's talk about the large employer, small employer component. In 2020, and again, the rules will change for 2021, a large employer is considered to be anyone that has more than 100 employees, and you have to look back to 2019, so don't be thinking of how it is in 2020, or certainly not what you are at currently. But you look back at your 2019 employee list, and unlike the PPP, remember that was the SBA, PPP FTEs was calculated on a 40-hour per week basis. The IRS is in charge of the ERC, so they went with the Department of Labor definition of full-time equivalent. So it's 30 hours per week or 130 hours per month. So it's a very different calculation, and you can see why this gets very confusing to clients. If you're a large employer, I have bad news. So if you have more than 100 employees over the course of 2019, and we won't get too into the weeds of that calculation, but let's just assume that's the case, then you really can only count the wages for the people who you paid to stay home and do nothing. That doesn't mean stay home and remote work. That means literally staying home and not doing anything, not providing a service. That's the only wages that you can count towards the credit. If you're 100 employees or less, you can count any wages. You cannot count things like PTO. Obviously, that was accrued prior to that time frame, or normal severance payments if someone leaves, or any wages where you had the FFCRA. You can't double dip. You also can't count wages where you're claiming PPP forgiveness, or for any medical leave. So there's a lot of things that have to be backed out. The analysis for this credit is complicated, but very well worth it. There's a lot of credit available. So gross receipts. So how do you measure? It's pretty much the same as the PPP2. Gross receipts include all of your sales, less any returns and allowances. You would also add in investment income, so interest, dividends, rents, royalties, and annuities, less the adjusted basis of any assets sold. Keep in mind the decline in gross receipts doesn't necessarily have to be COVID related, just has to be a gross receipt decline. So I said you have two ways to meet eligibility. If it's a gross receipt decline, then when you find the quarter that you're eligible for that entire quarter. But I also said the other way to be eligible is for a full or partial suspension. Well, that is the case of quite a few restaurants where there may be particularly a partial suspension. So we're going to look at this closely. But the time frame then becomes the date that the government order started, and it ends on the date the government order ended. And you really need to find a government order. It can't just be a suggestion by someone that this would be best for, public health. It really has to be an order. So, obviously if a restaurant's ordered by a health department to close down for some other reason, that's not related to COVID-19. So the government order has to be specifically related to COVID-19. So here's a few examples. Example one, a car dealership is open for business, but there's a big decline in sales. Is that a full or partial suspension? No, because that's related to the customers not coming in. That's not because they have any reason that they have to be closed. But in example two, a restaurant has to close their in-room dining. And that would give you the argument that you are partially suspended. What's important to remember about that is that a partial suspension, maybe a drive-through, maybe you went no in-room dining and everything is drive-through, and maybe the revenue went up over time. It still is considered a partial suspension, because if your in-room dining normally was more than 10% of your revenue. So if it was a significant, and that means not nominal, portion of how you generated revenue, then you can claim a partial suspension. Let's skip down to the fifth one. A restaurant is required to limit capacity to 25%. That's a partial suspension. So I said more than nominal effect, and this is just a further example. Because the restaurant is closing that in-room or on-site dining, and that meets the requirement of being a more than 10% portion of their revenue, they would be partially suspended. Let's take a look at the next example. What about if we had the same example as one, but that 2 months later, under another government order, this employer is permitted to offer sit-down service, but the indoor service continues to be closed? Then that's still considered partially suspended. And in the last example, if they are permitted to offer indoor, but they have to keep people 6 feet apart, maybe that limits the amount of people you can get into the restaurant. Under those circumstances, they're still considered partially suspended. Aggregation rules. So you're fortunate in this industry where the PPP SBA guidelines allow some flexibility with aggregation. At this time, the employee retention credit does not. Therefore, all members of an aggregated group are treated as a single employer. So when you go to measure your revenue reduction or your employee count for that large versus small employee, you do have to consider all affiliated entities. And unfortunately, I said earlier that this is IRS tax code. So you'll notice in the third paragraph there that I have a lot of tax code numbers, and we won't go into the weeds of that. But basically, the aggregation rules are part of any type of controlled group of corporations or businesses that have common control under certain code sections. It's important, if you're unsure about how this works, to reach out to a CPA or attorney to get some feedback on that. That's an important rule that you'll want to consider. Qualified wages, just don't forget this. If you have any of related individuals working at the entity, you can't count those wages. So we don't want to put, Aunt Susie on the payroll and then get a credit for her. So the wages are only for non-related parties. There's actually a little bit of gray area, or at least a different interpretation of whether the more than 50% owner can be counted. Some say yes, some say no. A conservative position would be that someone that owns more than 50%, counting them as an employee retained doesn't really make sense since they're not going anywhere anyway. So I would assume that the more conservative position is to not include that owner. So this is the 2020 example. For the sake of time, we won't go into a great deal of detail on this, but you'll see when you get the slides that we've shown you kind of how to calculate the credit. We've only got 2 employees there. That's a $10,000 credit that might be due to the entity. And on the next slide, you'll see another example, similar situation, but and similar credit, but it shows you for even somebody that's only working 60% of the time, you might be eligible for a fairly large credit. So in 2021, originally this credit only went through June 30th, but it was recently extended all the way through the year. And here's the good news. The best news is that in 2020, the limit was $10,000 per employee annually. And then we took 50%. Now the limit on this credit is $10,000 every quarter, and you will take 70%. So whereas in 2020, you could only get a max of $5,000 per employee all year long, you can now get $7,000 per employee every quarter. That's a significant difference. And as well as that is the fact that 2 of the numbers also changed. One regarding the large employer is now 500 employees. So that's a lot easier threshold to get under. So you may remember earlier I said a large employer would be someone under 100, and everyone that was large could only pay credits for wages that were just for not working. Well, now if you're 500 or less, you can take all the wages towards the employee retention credit. So it's much more generous. Additionally, still have the revenue reduction, but it's only 20%, and you can still meet this requirement using the partial or full suspension rules. So there's a couple examples here for the employee retention credit that are 2021 examples. And so you'll see how they're really the same as the ones before, but the credit amount goes up. Keep in mind that you're limited to 10,000 per employee. So if the employee doesn't quite meet 10,000, you'll take 70% of whatever they do have. And this is a continuation of the last slide, because the first slide was for Q1 and this is for Q2. So you see now how you can accumulate credits every quarter as part of your calculation for this credit. We have a comparison chart here. This will also be available to you that kind of illustrates the difference between the 2. We've already discussed it, so I won't repeat, but it is a nice place to resource the information. And then I wanted to point out the payroll form, because this is how you ask for the credit, because people calculate and then they say, how do I get the credit? Well, the credit is on Form 941. And what I have here, it doesn't matter if you can't see it very closely because you don't need to really drill down in it. But if you see all of the highlighted areas, I wanted to point out that every one of those highlights represents a new line item on this form that's been around for a while that came about due to the pandemic. And my orange arrow points out exactly where the employee retention credit goes. So in my conversations with clients, I frequently see them say, well, wow, I'm going to get $500,000 of credit. And I'm just going to put that on the form and the IRS is going to send that to me. In my years of working with the IRS, I find it fairly hard to believe they're going to turn loose of that money without a little bit of substantiation. And in the recent guidance, they started to offer a little bit more detail on what kind of documentation you would need to keep. So just like we said in PPP, it's very important to keep a good trail to prove up not only your eligibility, whether you're a large or small employer, but also how your calculation came about. A couple of quick updates. Very, very recently, a severely financially distressed employer, which is someone that's more than 90% can count all their wages towards the credit, regardless of whether they are big or a small. So if you meet that level of severely impacted type of employer, everything counts. And then if you're considered a startup business, in other words, it's established after February 15th and their gross receipts are 1 million or less, then again, you're eligible even if it doesn't otherwise meet the eligibility requirements. So those are two great helps. So lastly, I can't mention this without talking about tax. So we all know that PPP is not taxable income and the expenses are deductible. Well, employee retention credit is not taxable income, but the issue will be that anytime you claim this credit, so my client that I talked with earlier that said he'd get a $500,000 credit, he's going to have to reduce his deductible expenses on the tax return in the year that he's claiming that credit by that amount. And at the moment, he won't have received that money. So he's reducing his deductible expenses by that amount, thereby making his taxable income go up before he receives the credit. That's not very encouraging news. And I know that that causes some people some concern, but unfortunately, that's the current guidance. We're thankful for the extension that Kaylee mentioned because we're hoping that some change might happen in the timing of that deduction. So with that, I'm going to turn it back to Krista.
Thanks so much, Jonna. Definitely informative, and I know you had a lot to cover and push through, so I appreciate everything that you went through. So we are right at the end of the session. I believe we've covered the questions from the Q&A box, but if we've missed your questions, I do apologize. Definitely still reach out to us. We want to make sure that we are providing that assistance. We do want to thank you to the Greater Houston chapter for inviting us to speak today. I hope this information was helpful and useful for at least starting a discussion with your accounting team. You may not know it all, you may not know all the definitions, but at least it's a starting point. And as always, we are here to support this industry and provide as much assistance as we can as we enter into this recovery year. So if there's anything that we can do to help, please do not hesitate to reach out to us. If there is one great thing that has come out of the pandemic, it's the QR codes. We love it. And so in an effort to feel, cool, we are providing you all with our QR codes, which will connect you to our LinkedIn page with our contact information. So again, feel free to reach out if you have anything. You can simply, pull up your phone and it should pull you up to our page. But thank you all for your time and efforts today. I know it was a lot. We appreciate it. We'll be sure to provide our slide deck to the association so you have that for a reference. And, we hope you have a good, wonderful rest of your day. Thanks so much, everyone.
Thank you.